So without further ado, Lori Harbour.
Thanks, Kim. Good morning. It's super bright up here. I can't see any of you. And I guess in the theme from Troy, I'd like to kind of follow for a quick second on the whole gratitude thing. Thank you to Troy and to Kim. I've had an 11-year relationship with them, so that's been very beneficial to me. I've learned a ton and have had great relationships formed from that. And for the AMBA, I mean, this truly is one of my favorite events every year because I have such great friends in this group, and to have it in my hometown is probably even more fun. And the other thing, just from a personal level, which most people don't know, but last year when I stood on this stage in Indianapolis, I was probably in more intense pain than possible, and a couple months ago I had a big back surgery, and I'm incredibly grateful that I can stand up here with zero pain, and so it's an awesome gratitude for me personally. And as probably most of you know and have heard, the other very exciting gratitude thing that we have in our organization is that we had a great new addition to our team this week with Todd Finley, so we're very excited about that and very grateful that if it wasn't for the AMBA, frankly, I never would have met Todd, so we're very excited about that. So today, as true to form, what you would expect from me, I have way more slides than I have time to present. So I'm going to jump in and we're going to talk a little bit about molding best in class. We'll talk a little bit more about what Kim identified in terms of the work we're doing with the AMBA on benchmarking. But I want to jump in and get started. Again, you guys know who we are and what we do. We have a booth out there and you guys can learn more about it if you're not familiar with us. So I'm not going to spend a ton of time on that. What I want to do is talk a little bit about some of the AMBA market trends we're seeing, how's the makeup of the AMBA and how that contributes to the data, what's going on in some of the markets that you're impacted by, some of the geographical things that are starting to emerge in tooling, some of what was talked about in the panel previously. We'll go through some of the data and then we'll lastly, of course, talk about how you can leave here with some nuggets of things to go work on to improve your business. So I'm going to dive right in, and this is probably not overly new information to you guys, but I wanted to really, now that we're getting all this AMBA data, we wanted to kind of look at the makeup of the organization. The size of these boxes that you see is based on the number of AMBA members out of the 200 or so members that we have that fall in these size ranges. So this is just the count or the number of shops. And so as you would imagine, the AMBA is largely made up of shops under 15 million. There's a handful of shops that are over 15 million and over this 50 million mark. But what really starts to emerge when you change the perspective of how you look at the data is these boxes are made up of when you sort of sum up the revenue of those shops. And so things begin to shift around a little bit in that those larger shops over 15 million start to have a lot more market influence. They're larger and their revenues sum to a much greater amount. Still 5 to 15 million is a large grouping, but you see the 50 to 100 million, although it's a few number of shops, tends to grow and show a greater market influence. Now, if you look at what the AMBA does and the markets that they are operating in, and this is by no means all-inclusive of all markets that you could make tools for, but the AMBA asks what markets you play in or you make tools for. And we wanted to just show kind of what the largest groupings are. There's really 5 industries that really stand out. Automotive, of course, aerospace, you've got consumer industrial, which is just made up of a ton of different types of tools. Medical and appliance, those are kind of the big 5, and then you see some of the smaller categories. Doesn't mean that you're not playing in some of the other industries, but these are kind of the ones that stand out within the AMBA membership. And this was important for us because as we start to do benchmarking, we want to make sure we're talking about what's going on in each of these industries that you operate. If we look very quickly at sort of what's going on in the economy, obviously you know there's a ton of things affecting what you do business in, not the least of which is this big, huge election we have here in the U.S. coming up in a few months, and how that impacts the industries that are launching new products. The strengthening of the U.S. dollar is obviously playing a significant impact. We'll talk a little bit more about that later as we look at some of the Canadian and U.S. Situation. Fuel prices are having a massive impact also on both the exchange rate and multiple other industries that you may produce tools for. The U.S. economy relatively stable, although GDP growth is not nearly what it should be or what it has been in the past. It's just a couple percentage points. You see commodity prices, falling, and so things like steel and resin, the prices are much more favorable. But around the globe, a very uncertain economy, whether it's Russia or the BRIC regions, China, many of other things that are affecting the global economy. And then you have this thing called regulations, whether that's EPA regulations in medical or automotive CAFE or whatever it is, regulations having a huge impact. So overall, when you look at this economy and we put things together, we still think that there's a very strong outlook for U.S. mold makers. We'll talk more about that because I know that several of you have asked me about some of my forecasts in tooling, and so we'll address some of that as we go on. But a strong look forward. If you look at some of the industries you play in, I think the thing that starts to emerge that's important for you to take away from this is that since we came out of the recession and all of these industries were rebounding, what we saw was double-digit improvement in sales and in revenue of your customer base, right? But when you start to look out to 2020, and this is a whole host of industries you look at, and their compounded annual growth out to 2020, you're starting to 2020, you're starting to see the industries become much more flat in their growth. And so it was very easy for these companies, whether it's a General Motors or a GE or a Polaris, to make money on double-digit return of the economy from the recession. But now as we look out, we're starting to see much more of a flat line across several industries. And we'll show how some of that plays out in the trends as we look forward. So coming back to the AMBA just for a second, we picked some of those key industries that you're in. And what you see on the x-axis of this chart is the actual size of that market. So in terms of revenue dollars of that market, you see that on the x-axis. On the y-axis, you're basically looking at the growth of that industry. And the bubble size is the number of AMBA members that play in those industries. So if you look to the right, obviously automotive and aerospace, much larger markets, but very low growth rate. Of course, a lot of companies in the automotive space. Whereas you look to the opposite end of the chart, appliance pretty much flat or going backwards, still a pretty good size bubble of AMBA members that are producing there. So again, overall, when you look across this, relatively flat across the industries, but a huge effect to many of you that are in that space. So I want to talk for a second about automotive because for the most part, as I have shared with you in the past, we see this huge impact of automotive demand in the future, and I have obviously predicted a significant demand of tooling coming in the 2018 timeframe, and even to some degree maybe a capacity problem. And people caught me last night over drinks and have called me and said, like, you're just wrong because we haven't seen it. We've been super slow. What's going on? You have, if you know, in 2025, the CAFE regulations are talking about the average of vehicle miles per gallon needs to be 55 miles per gallon across all of their models, right? With variation to the law, obviously. What's happening is all these products that are launching in 17, 18, 19 are not going to be redesigned again before 2025. So they have to meet regulations when they launch in 2018. So what's happening is all of this new model launch stuff is bottled up in engineering right now, where powertrain can't meet the emission standards, we're lightweighting the vehicle, and we're pushing back and forth, so programs are delayed. So what's going to happen is you're going to see some move out to 19 and 20. Frankly, you might see some get dropped because they can't meet regulations. And so there's a lot of movement. The big three told me that they're redoing their entire architecture of vehicles over the next 6 years in order to meet this CAFE regulation. So it's a much bigger deal than people think. And that's why we've seen a little bit of this valley or trough on the automotive side. The other thing that we're starting to see, and this is not just an automotive phenomenon at all, is that the market that used to be very, very high volume and very low mix is changing to a very high mix and low volume market. New consumers want customization, they want features on their products, technology. So what you see on the left is the number of models in production for a vehicle, an Impala, an F-150, that kind of thing. And that number of vehicles is going up 18% by 2018. But more importantly is the chart on the right, which is that all of these vehicles that are on the road are starting to come down in volume. By 2018, 80% of every car on the road will be under 100,000 units in production. So this means more difficulty in amortizing tooling, in managing piece price, and in managing within the molding facilities the parts that they have to produce. And that's just a model name. That's not trim. That's not body styles. So complexity growing, in mix growing within the organizations, but also on the complexity side. We're seeing mix change within appliance and aerospace, but we're seeing products become more complex. Whether it's a bumper fascia from 10 years ago to today, differences in styling, whether it's an appliance that has more technology, more connected appliances, all of these features. And then, of course, you got the airplane side of it. This is the Dreamliner on the bottom right. And this, when you study the Dreamliner, if you've ever been on one, it's just crazy. I mean, the technology, anything to tinted windows to technology in the seat in front of you. So products becoming more complex, which means tools are becoming much more complex. So what does all this mean when you put it together is that I don't care if you're General Motors or Polaris or John Deere. We studied a bunch of financial statements over the last couple months of what their tooling asset spend is, and the trend is the same. This is just one that we pulled out, an OE that is looking at their tooling assets, and over a 5-year period of time, the growth has been $4 billion. So, I mean, we're all smart enough to know that there's no CEO sitting at the top of these big companies saying, keep that trend going, let's keep spending money, right? So this tooling focus is becoming a very big deal within the big companies and down to their suppliers, many of the tier 2 and tier 3 molders that maybe were on the panel and that you guys are working with on a regular basis. So tool cost is just becoming a very untenable thing that people have not been used to within the big companies like we have been since the recession. This is another example on the aerospace side. If you look at this Dreamliner and the 787, they were very vocal, Boeing was, in their own financial reports that the tooling total cost for this airplane was $5.5 billion. And currently today, they lose over $15 million on every single airplane that they produce. And they blame a lot of that on the tool costs that went into this particular airplane. So this thing's not going to make money for a very, very long time. So again, it doesn't matter what industry you're in. We're seeing it in construction. We're seeing it in medical. Much more focus on tooling costs than what we ever had before. So one of the things that emerges is you start to see people in purchasing go, how do we handle this? What levers can we pull in order to try to save money and drive down the cost of the total product? So there's these geographical levers that I want to quickly talk about because they're affecting us probably today far more than when I stood up here a year ago. The first one is, frankly, 30 minutes down the road, I can take you across the border to Windsor and I can get a tool for 20 to 30% less because I have an exchange rate advantage that's really affecting those of you in the audience who are U.S. mold builders. The rate has gone down dramatically, and by January of 16, it was down under 70 cents to the dollar. It rose again in the last couple months, and then it's expected to drop considerably. And right now, the economists are saying there's no sign of this changing, largely because Canada has a huge business in export of oil, right? And it's down so considerably that it's really having an effect on their exchange rate. So I want to talk briefly about what this impact looks like. We're gathering hundreds of shops of data, both Canadian and US, through Harbour IQ, and we said, let's go look into some of the financial impact of this. So as an example, using some of this data, if you take $1 million package that comes to a US and Canadian, call it, when it was at parity, back when the exchange rate was at parity, you had on average companies making somewhere between 10 to 12% EBIT, earnings before tax, and interest, and then you have the raw materials somewhere around 19%. Everything in the gray is all the rest of the cost, and frankly, they're almost at parity, and I didn't want to get into a debate about why somebody's wages are 1% more than the other. It's generally the same. Now, if I take that same $1 million package and I fast forward to a difference in exchange rate, here's what happens for the Canadian at 0.70. You have the US still at that similar profitability in material. What happens in Canada is that material goes up considerably because frankly, they're buying most of the material over here. So their cost goes up, but what happens is their profitability soars and they're up to 28% from an EBIT standpoint. Now, what happens is we all are looking for work, and so we get competitive in our bidding, right? And so the U.S. company says, I got to fill my shop, I need to land some work, and so they competitively bid, but the problem is they give up most of that margin. The Canadian, on the other hand, has a whole lot more margin to play with. And so he drops that down, still makes 15, 16% margin, and the US company's not making anything. So, and these are illustrative numbers, but coming from real financial data that we're looking at and real programs we're looking at. The takeaway here is that the companies, be it automotive or we've seen it again in appliance and others, are filling up the Canadian shops first because they're taking advantage of that savings. Sort of like low-cost country without having to go 13 hours over to China. I would be remiss if I didn't talk about China. It's not my favorite topic any more than it is yours. Obviously, the Chinese market has gone through a significant economic change. Exports were actually negative in 2015. The problem is it's not necessarily that way for tooling. We watch about 60 shops in their capacity and their growth. We just had a team over in China 2 weeks ago that visited 14 different shops, and their compounded annual growth rate over this period of time has been almost 13%. So they're growing, and 70% of their business is all export. So bottom line is China's not going away. I mean, I think you heard that loud and clear from the panel before. It's still a challenge, but this Canadian thing is also impacting in that several Canadians are winning work from the Chinese. And the Chinese aren't stupid. They price that number just about the right amount that they can price it to still make ridiculous money and still beat the US or the Canadians. So it's still a challenge, and we don't really see that changing going forward. The last thing I want to talk about is Mexico, which most of the time when I bring up Mexico, people think I'm crazy because why wouldn't I just make a tool in the US and ship it down to Mexico if that's the situation? I just want to kind of put this in perspective. The automakers have announced over $24 billion worth of investment in Mexico in the last sort of 3 to 5 years. It's basically nearly a third of all the spending. Every automotive company, the one we forgot on this list is Kia, they're even building a plant in Mexico, has put new facilities in there. There's also over 300 aerospace companies in the heart of Mexico that are making components for airplanes and exporting over $5 billion out of Mexico for aerospace. And then, of course, several of these other companies, many of you support, a GE, a Polaris, a CAT, putting facilities down there. So the market's growing considerably. So the natural question is, are tool shops following? And it is happening. There are several tool makers who have announced and are building plants or have built plants there, largely all Canadian shops. Not sure I know what the demographic difference is there and why they see the value. In the US are struggling. A couple of these plants at the top are on the border into Texas, and so that's how they've gotten close. There's a US mold maker that's announcing a plant for next year. By no means there's a flood of shops down there, but they're not just doing maintenance. Most of these shops are actually building tools. We were in Mexico in February and visited about 8 shops, and they are absolutely building tools for the Mexican market. So the reality is there's thousands in Mexico with molders, and those people need tools and they need maintenance of tools. So let's jump in and talk a little bit about the AMBA performance. Kim talked about kind of our new partnership with the AMBA that we started at the end of last year. We started doing some very specific things. There was a benchmarking site actually right on the AMBA site that any of you can access and go in and get some of the information that we're posting on a regular basis. My team is here. Those of you who filled out the most recent survey, we have actual customized reports for you with your company name on them that are out here. You can go through with our team, so I encourage you to go there. What we did was we started with the wage and benefit survey. So that survey was done by the AMBA. They executed that, and there was a box that you could check to say, I'd like to share my data with Harbour. So out of 195 people who provided data, 125 of them said, yes, share my data with Harbour. So we've put that in the system and factored into our analysis. In the survey we executed, which was in March timeframe, we had 45 AMBA shops that provided extensive data, and 26 of them that gave us very detailed financial information. And so what you see on the left is kind of a summary of that, kind of AMBA by the numbers. The median of the AMBA shops is about 8 million. The average is much higher, largely because as soon as I get 3 or 4 of those $50 million shops to put their data in, it means the average bumps up. So we wanted to show both. And you can see kind of the profit performance and number of people. Prediction of growth by the AMBA membership was 5% in 2016, so people are seeing some very positive outlook. And then, of course, we do our revenue per full-time equivalent, which I've presented to this group many times, and we'll talk a little bit more about that. But this is kind of the summary of that, and we have a ton of data that we can share with you, but remember I told you I have 45 slides in 45 minutes, so I don't have too much time to share a ton. So I'm going to hit the highlights here. The first thing is profitability. We split this data by under 10 million and over 10 million. And when you do the analysis, frankly, that's the right place to split for this group. Again, we've got, this number of shops that are larger companies, and we have the majority of the membership under 10 million. This shows you in the blue line their gross margin, the SG&A, and the EBIT performance. I don't think it's any surprise to all of you that you see SG&A go down dramatically as you become a bigger company. You're seeing much more leverage of that salary staff. I think that the interesting takeaway for us as we go around and do assessments is that most of the small companies we go to tend to be pretty top heavy. And that's not a bad thing if you're only 4 or 5 million. We realize you have to have some of those staffs. What we're not seeing is we're not seeing the growth. The reality is you should be able to go from 3 or 4 or 5 million and grow into your SG&A. And then that challenge becomes, I was talking to one at the break about, do I really want to grow? Do I really want to be bigger, right? And we talked, I know Kelly mentioned it, typically what happens is we see the president as the head of sales. And so we tend to try to consolidate some of those functions, right? So this is just a look at the profitability on average. I want to dive in a little bit to some of the cost of goods sold. Now, I haven't put everything on here, but I just want to highlight a couple things that we think are pretty interesting in the data. When you look at wages, you see a pretty significant drop in wages as you become a larger company, which as we travel, we're assessing 50, 60 mold builders a year. And as we go around to these plants, this is absolutely in alignment with what we see. As companies get bigger, they're adding more technology, they're taking more individual handwork out of the business, and they're utilizing their people better. They're really driving throughput and efficiency, which the rest of the data validates. And so wage cost comes down. Material is a little higher because, frankly, as you get bigger, you tend to make larger tools, so your material cost is a little higher. The subcontracting one is interesting to us because, remember, 14% is an average, right? So it means I got guys who are 20, 25% outsourcing and guys who are 5 or 6% outsourcing. What's significant about this is that, again, as you get to some of these larger shops, you're starting to see some of these new models emerge. The big shops are, let's say they're 30 million, they're selling to 40 or 45 million, and then they're flexing their business by using either China or several of the smaller shops in town that they're friends with. So we've got a whole group of suppliers that kind of live and die on the big shops in terms of business, which is great for small tool shops. The problem is when you go into a trough like we were just in, when those big shops get a cough, you guys get the flu. And then the challenge becomes, how do I find work and how do I keep myself busy? So the subcontracting thing is something that we're seeing really be leveraged in a lot of the larger facilities. So this is our revenue per full-time equivalent. This is total revenue less what you subcontract divided by your employees, but factored in overtime. So that's where the full-time equivalent comes from. So if you look at the orange bar, this is the AMBA average. So this is about $150,000 per employee. Not a bad number by any means from an average, but again, you got shops much higher and some that are much lower than that. If you look to the left and right of that orange bar, again, we split it out by under and over 10 million. Again, as they're leveraging SG&A and as they're using more technology, we tend to see higher throughput in some of those larger facilities. And then you look to the AMBA members under 10 million, it's a little bit lower. Now, I put a couple others on here for interest. The Canadian shops, much higher, typically more like your over 10 million. There's a dynamic for this. If the American mold builders are largely those small shops I showed you in the beginning, if I went across the border to Windsor, it would be completely flip-flopped. The Canadians are largely shops over 40 million, and there's a handful of shops that are under 10 million. And so what makes up most of this number is very large, typically automotive shops in the Windsor area. Interesting is the die shops. So these are stamping die shops. really, really struggle to get themselves into a throughput mentality and be able to drive it. They would say that making a die is much harder than making a mold, and you guys would tell me making a mold is much harder than making a die, but it's an interesting comparison. And then I put a couple other things on here, which I know many of you will look at me and say you can't even think to compare me, but I thought, let's just put some perspective of what the producers are doing. So your customers, the molders, what does their throughput look like? And on average, and we do probably 30 or 40 plastics assessments each year as well, they're in the 180, 185 range. Again, some much higher, some lower. I put die casters on here because several of you make molds for die casting facilities. And the die casters, I used to say tool building was the most archaic business I'd ever been in. And then I went to a conference in Naples with the die casters, and I was like, no, they beat it. They're way worse. So it's a very interesting dynamic, and this is all about throughput in their manufacturing facility. To dive in a little bit to what makes up some of this, we started to look within each of the groups, designers, machinists, and mold builders. And so what you're looking at is the average number of people broken out by size ranges that are in each of those departments. The darker part at the top of the bar is the full-time equivalent. It's the factoring in of overtime, right? So there's a couple key dynamics about it. We typically used to always see sort of a 1-2-3 kind of a ratio. And if you go into some of the smaller shops, you'll see some of that, or at least a 1-2-2 kind of a ratio. As we get to the over 10 and over 20 million, we started seeing this dynamic where I'd get out to the mold builder side of it, and it would be sort of like 1-2-1, and you'd see a huge drop on the mold builder side. So I started talking to several people about it and had a conversation with Todd last week, and he said, yeah, when we start to look at all of the technology going into the product, right? So more complex tools, like we talked about earlier, take a lot more components to feed those tools. So we have to machine more, right? And you've got new technology coming in that's allowing us to machine to more of a near net kind of a state. So I'm taking less of the hand work out, less of the bench work out, right? And so as these companies are getting bigger and making that investment, you're seeing some of the labor side come down on the much more manual side of it. And frankly, we're seeing shops align skills better and really get people focused on the things that they're best at and get their value add up. Now, when you go to the huge shops, it's kind of back to 1-2-2 again, right? I'm getting a bunch of stuff from China, and then I bring it back in, and then I have to productionize it, right? So I'm not necessarily doing all the machining, and I'm not doing all the assembly, and I bring it here, and I have to do more of that productionizing. We're just seeing a whole series of kind of different models emerge within many of the mold builders that are in these very different sizes. I want to talk quickly about capacity because it's one of the things that has, frankly, as we've traveled the last 6 months, just been the biggest issue that most people have talked to me about is we were doing pretty well through 2015, and this is not specific to any industry. We have shops in this data from all industries. And, sort of beginning of fourth quarter, things just started to kind of really slow down and, quotes slowed down and backlogs started to go away. And by the middle of the first quarter, capacity was down on average about 66%. Now, again, remember, this is an average. I could show you shops that never dipped at all. They rocked at 80, 90%. And shops that were down around 30, 40%, frankly, gasping for air, looking for work, laying people off, shops on 32 hours a week, that kind of environment. We're starting to see things pick back up again. Quote logs are really getting busy, and you're seeing backlog build up. One of the interesting things that drives this is through one of our other surveys that we do, we measure what we call jobs on hold. We ask people at any one given time in this quarter, how many jobs did you have on hold, in what terms of percentage? And in August, it was 12%. By January, it was down to 20%. Heavily weighted by some of what I talked about in automotive, but again, other industries. You'll hear later from one of our appliance panelists, things just sort of slowed down and we put things on hold. The election's got some uncertainty for us. We're not sure about consumer spending. So that's part of what's driving this. And to show the split between auto and non-auto, because I said, well, what is that really a difference? You can see automotive really higher and a lot of these other industries still not projecting too much change. And there's high inventory in some of these industries. And so as you look out, a lot of the tool builders, although they'll tell you they have strong confidence in the future, are looking forward saying, I'm not knocking the cover off the ball. So to summarize some of the data, what we're starting to see is what I would call sort of this emergence of the haves and the have-nots. That's kind of our term internally. What we did was we took an aggregated group of about 25 shops that we thought were doing really well on several key factors. And we looked at their EBIT performance and we looked at their throughput. So kind of the top, quartile, 25%. And then we looked at sort of the bottom quartile and said, what's the difference and where are we seeing the gaps? So on the left, what you see is their EBIT performance, their average, and then kind of the high and the low. And then on the right, you see their throughput performance, again, average and high and low. I put the AMBA average on there at about 150. The key takeaway about this is that, first of all, the people I have in the haves are not all big shops. About 50% of this group is actually under 10 million in the haves. And they are hitting 12, 13, 14% regular EBIT return through their business and are driving throughput at 180 plus per employee, really focusing on some of the core elements of the business. The concern I have is that if we hit this, now the double-digit growth is gone and things flatten out, this means industry people start fighting for market share, right? And so when that happens, the question is, if we see a trough or we see a slowdown, this is back to that sort of getting a cough or getting a flu. The guys that are in the have category, sure, they're going to lose margin, but they're still going to be okay. Some of the shops that are at 5% or under are going to be down to a loss. And I'm not 100% sure that all of those shops can get themselves through that again like we did in 2008. It's a challenging, much more challenging time with not quite the recessionary period. So we're starting to kind of see these models emerge. What do the haves do well? They're investing in people. They're investing in technology. They're training and developing strategies to work on, frankly, some of what you heard in your previous speakers about engaging workforce and making an impact. That's what the haves are doing very, very well. So one of the things that when we went into this trough of sales, our team started hearing on all these assessments was, what's going on in sales? What are we doing to get sales? And frankly, the phone kept ringing saying, do you know anybody who's looking for tool builders? We're desperately trying to get sales. So there was this sort of feeling amongst our group that people were really struggling on the sales side. And so it was anecdotal. We said, let's look at the data. And in our assessment, we look at 9 different categories, and one of them is sales and marketing. And so I asked the team to pull the sales and marketing scores. Let's try to figure out what's going on. The gray line on top is the sum, it's the average sum of all the 9 sections. So it's performance of the companies across their whole business. So relatively flat, little bit of improvement. If I split just the sales scores between under 10 and over 10, the orange line is those large shops. And I contend that when I'm 30 and 40 million, I better be good at sales because I got a really big mouth to feed that's going to be really painful if I don't keep it fed. But on the under 10 side, what we tend to see is that, presidents are the head of sales. They run out and they sell, and after they run out and sell and land it, then they're out on the shop floor making it, right? And so you see this sort of up and down trough of business. But look at how disturbing these sales scores are. And this is, guys, we assess 50-some plants a year. Some of them are 50 million and some of them are 3 million, okay? So this is a mix. But what you're seeing is that people are taking their eye off the ball on the sales side. It was much easier years back, and now we're just not seeing the focus. So we looked at what the main drivers are. These are the categories that we look at in the sales section, and you can see things like marketing, which Kelly Goodsell talked about, which was interesting, and I know most people in tool building think marketing is crazy, but one of the weakest categories, and then target markets and things like that. So I want to use that data to pivot in my last 10 or 15 minutes here about kind of how do we position ourselves for success. Most of you guys know I'm sort of, me and my team, really, we are shop rats, right? I mean, I spend 2 to 3 days a week in a plant doing work with shops on the shop floor. So that's where I'm comfortable. That said, when you start to look at the total business, we have to look beyond just the floor. And as we started doing this work, we said we've got to start talking and looking a little bit more at sales. So you're going to hear me talk about something I've probably never talked about, because usually I talk about how you got to get better on the floor. But I want to talk about the sales piece a little bit. These are our 9 sections that we study in the assessment. And the point of this is that we actually look for continuity across all 9 of these sections. We would rather see everybody score 50 across all 9 sections than have one at 80 and one at 40 and one at 70, because that tells me we have a leadership problem. And so what we tend to see happen is what you see on the right. And I'll tell you that anecdotally, most of our assessments lately, this is what the curve looks like. Sales and marketing with little focus, but we're working on, building and project management and finance and all of those other elements. And in order for a company to be strong, they have to be equal across all of them. So, when I go to shops, we tend to talk a lot about this whole effect of turbulence. If I had $1 for every shop in the last 6 months that I visited that said, if I could just have 4 quarters of consistent production, I would have a profitable year, right? And I'd be rich because I'd be getting $1 for every one. It's just a common thing, and this is that life of the tool supplier I've talked about before. When you're running on this orange line and you're at the peak, you're outsourcing work, which you're not making money on. You're running a ton of overtime. Your margins are coming down. And you're potentially giving up work because depending on when they come to you, you're saying, I can't take this on. And then when you're in the trough, you're, of course, filling hours with non-value added stuff, right? Painting machines, painting walls, doing maintenance, that kind of stuff. And you're taking work at cost and really having an impact on your margin. And so this effect of turbulence is huge. The blue line that you see there is obviously the optimum. Now, most of you would look at me and say, this is an illustrative example, right? And I would say, no. Remember that have group that I showed you? They run on that blue line. This is real data from their performance over the last 12 months. That's the haves blue line. They are working diligently to trim off the peaks and the valleys and run at this level loaded capacity. Because at the end of the day, if they can run level loaded, they can drive profitability, even if they're taking some work at 2 or 3% and some work at 10 or 12%, right? So this effect of turbulence is significant, and it's really the driver and focus around this discussion of sales. So in this diagram, which I know is super busy, we have been working with shops on this sales piece, and we started to develop kind of this strategic selling process because as we went in and dove into it, we found all of these gaps. And this process is not intended necessarily to be linear and that you should do step 1 to do step 2. Frankly, several of you do pockets of these things already. And the challenge is being able to bring it all together and drive sales. Now, most of you that are small will say to me, Lori, there is no way I can do all of this work because I'm the head of sales and I'm the president of the company. But there are people in this room, Kelly said it himself, there was other people who walked away from Jack Daly who spoke here a year or 2 ago as well and said, hire sales. Yeah, I'm only a $5 million mold shop, but I'm gonna hire a sales guy. And some of those same people would tell me it was the best decision they ever made, because they were able to start working on the business and bring a consistent flow in. So what I want to do is talk about a couple key points today and just give a couple examples of where we're seeing some of the best shops have an impact at driving to that blue line and level loading the process. So I'm going to talk first about hit rate. How many of you, by a show of hands, actually measure your hit rate? I can't see a thing. Okay, so that's a good number. How many of you actually spend time every month analyzing your hit rate and making decisions from it? There's not as many hands. So I want to show you a couple examples. This company on the left, real data, about a $24 million mold builder who absolutely was capturing data on hit rate, was quoting like crazy. Their mantra in life was, quote, everything and everybody, no matter what, because you don't want to miss that opportunity when that one guy decides to give you a piece of business. So in a 14-month period of time, he had done 4,500 quotes. It was about $2 billion in quote volume, and he has a less than 1% hit rate overall across the business. But what was interesting, we started digging into the data, was 64% of the quoted customers had never bought a thing from that shop in the history of that shop. So you're going, okay, well, so why do we keep quoting them? Well, you just never know when that one time they're going to give you a piece of, a tool piece of business. The top 10 customers made up 75% of their total business. So this just shows you a couple, customer 1, 2, and 3, they're quoting just an unbelievable amount. This team has 5 people doing quoting. 5 people, all overhead in the business, right? Now, another example on the right-hand side, this is a really small mold builder, about $10 million mold builder, who has a very different philosophy. They don't quote anything that walks through the door. They have a very desirable hit rate, frankly, 12% overall hit rate in their business, but it's on 3 key customers that they're making all of that, sometimes upwards of 40% hit rate. Now, when you go down the list, you've got a bunch of other customers that you're not hitting that same kind of hit rate. But what was even more interesting is look at a company like Ford. They're quoting $2.2 million of tooling at Ford. How much do you think Ford spends on tooling a year? $4 billion. So they're not even getting a crack at it, but they're a 41% hit rate. So your first thought, for us anyways, was shouldn't we be going and talking to Ford and figuring out how we can quote something more like, $10 million or something like that with that kind of hit rate? So very different situations, but what was really interesting was that neither one of them, although collecting the data, so we go in to assess and we go, can we see your hit log? Yep, great, cool, you got it. You think I'm going to give you a great score for that, right? Now let's talk about how you use it to make decisions in your business. Oh, well, we don't even talk about it. We don't even look at it. We just track it, right? So this is a big part of it. This reveals incredible stories. Frankly, it reveals unintended strategies in your business. You might say, hey, this is who I am. I'm a mold builder that does this, this, and this, right? Reality is, when I look at your quote log, that's not really what you do because you're not quoting to what you said you do as a business. Now, we understand hit rate, we have to start looking at profitability on a customer basis. This is another mold builder. If you look at we did this whole analysis of them. They too were gathering all this data, and we said, let's look at it. And their top 10 customers, who were 90% of their business and most of their profit, on average equated to about 18% of their profit. So the owner said to us, before my team did the analysis, he said, I got all these other 19, 20 customers. I just need to get rid of them. They're not any good. They're just complexing my business, right? So we did the analysis, and that 19 customers is 59% average profitability. So my team went, wouldn't you maybe sift out some of the dogs on the left and maybe look at 3 or 4 of the guys on the right and say, how can we grow our business with you at that kind of profit margin? Now, that may or may not be the right answer for your company. Every company is different. But the reality is, if we're not looking at the data and reacting to it, it's very hard to make those decisions. So it's critical to look at the data. It's critical to develop those metrics. Looking at it every day, every week, every month, to be honest with you. Am I quoting enough? If I'm a $10 million mold builder and my hit rate's 2%, how much do I need to quote at that hit rate in order to stay 10 million or bigger, right? So am I quoting enough? Am I getting a high enough hit rate? So we have to trend it, we have to analyze it, we have to respond to it, and we have to then go back and reevaluate our strategy. So the other piece I want to highlight that we've seen from some of these shops recently that are just really having wild success on leveling their load is that they've started to create a couple tools to help them run the business. What you see on the left is something that I would sort of call a business development filter. And frankly, we had some input into helping them do this because I actually run my business this way too, because we are a tool shop. I mean, I sell time for money, so I peak and valley. So we had customers come to us in places and regions of the world or in type of business that weren't appropriate for us. And so we had to create sort of a business development filter. So we looked at some tool shops who started to do the same thing. And they're asking questions like, what kind of mold is it? What industry is it? What's your lead time? What's the size of the tool? Payment terms? What's my hit rate with this customer? Is it good? Is it bad? We have this thing we call the PETA factor. You guys can probably figure out what that is. It's sort of pain in the fill in the blank, and that's really they're really hard to work with, so I got to charge them more, right? So the point here is that some of the best shops we're seeing are running through all of their quotes through this filter. Takes them 10 minutes tops, and they come out at the bottom and they go, I've got 100 quotes to do this month. I'm probably going to work on these 50 first because they align with my vision and what I'm trying to do, and probably prioritize the others later. And then on the right-hand side, and frankly, this lines up with something that Kelly Goodsell talked a lot about, and it's what we call a client plan. And again, very simple tool to use. It takes people 10, 15 minutes to create, but it's that tool to manage that client. So if you remember that customer, the hit rate data I showed you, we asked our client to create for those top 3 customers a client plan. We asked them to go sit with the customer, and believe it or not, they're one of their best customers. They had not even sat in their building in 4 years. How are you going to get the business that way, right? So we had them put client plans around how often they were going to visit them, what they were going to ask them, what were some of those key questions, kind of like what Simon talked about. How can I be better for you? But the other thing is that in doing this client plan, they had it in front of them on a regular basis of how they were going to take action in their business and be able to prioritize. And lastly, that shop I showed you on the left that quoted 4,500 quotes, we encouraged them and they went and did it. They asked for the work. And they asked from 3 shops if they could be last right of refusal, and 2 of them said yes. Guess what's happening to their sales? Because now they can decide, do I want to come down that $2,000 or that $30,000? Or nope, I'm full, I'm good, I don't need to do that, right? But what we're finding shop to shop is we're not asking for those things. The other piece I just throw in here is that it's too often that I find people don't have market data and information. I picked auto because, to be honest, automotive does the best forecasting out there, meaning providing the tools. I can't say it's always right, but if I try to look at aerospace or I look at appliance, we can't find the same kind of forecasting. The point here is that you have to take that hit rate data, you have to take outside market factors, forecasts, what your customer's telling you, and build a plan that goes into these client plans. And, who's the incumbent on the product that's coming out new in 2 years? Did I make the last tool? Have I quoted these programs before? What's my chance of winning? What's my hit rate? You have to go through some of these key questions. So a couple last things. I have just 2 slides to share with you to wrap this up together. Again, I know this is an incredibly complex process. For some of you, you'll do all of this. For some of you, you'll do some of it and not every piece. And that may be okay, but the key to this is that you can't just cherry pick 1 or 2, 3 things and have them make a total difference in your business. Most people say, Lori, where do I start? I don't know where to start. And the first place we'd always tell you to start is with the data. People have this data. Some people have great data, but it's not information. It's not telling them anything. They're not reacting to it. Other people don't even have this data. I'm surprised by the shops we go to and say, can we see your hit rate log? And they go, what's that? Second piece of it is gathering that market data. I don't care if it's a forecast. I don't care if it's going to a conference where you're going to hear some of your customers speak. Wherever you can get economic data on that industry, wherever you can get information that helps you be more knowledgeable. And the third piece is, for God's sake, talk to your customer. I can't believe the people who don't get out and talk to their customer. Kelly said something very interesting today that I hope everybody caught on to, but it's come to my shop. Come and see me. Business doesn't just come anymore. We have to go to and visit. What do you got coming? What can I do better? All of these kinds of questions. So the last piece I want to leave you about on this chart, I don't know if anybody really noticed it, but we have sales planning, we have operations planning. I haven't talked a lot about operations planning, largely because my focus today was on sales. But you've heard me say this before, these 2 sections are completely inextricably linked. And every shop we go to, time and time again, I've got operations people running off trying to build capital plans, trying to schedule their facilities, trying to build capacity plans, and they haven't talked to the sales guy in a month. So they don't know what's coming in. They don't know what's reacting. Frankly, there's operational data that would give you answers on the sales side of where to target and what to do. And so these 2 have to be inextricably linked in terms of planning and how you manage your overall business throughout each of these categories. Again, I know it's complicated, and we certainly can talk more about it as we maybe over cocktails make it easier to look at, right? So I want to just leave you with these couple things. Where to from here for you guys as organizations? You have to evaluate the sales process. It's very easy for people to go in and go, how do I fix my operation? How do I get throughput? I mean, yes, I'm an operations person, but I can work on my plant till I'm blue in the face. If I don't have a top line, what matters? I mean, it just doesn't matter, right? So we have to evaluate the sales process and what we can do to bring more business in and level that load. Look at the data. What is it telling you? How do I react to it? You don't have to do every element of that chart, but if you can take that data and at least have a weekly meeting or a monthly meeting to talk about what's happening and make some decisions, that's going to make you better, right? You're never going to be 100% level loaded, but if I can be 50 or 60% closer, then I'm better off, right? Adapt your strategy. Remember I mentioned those unintended strategies? How do I go after the customers I want to? What have I been bidding on versus what I really want to be bidding on? Align that sales and operations planning like we talked about. Make sure they're inextricably linked. And then feedback, feedback, feedback. I can't tell you how many times I go and see people who are not gathering lessons learned. What was quoted to actual? What did we do right? What did we do wrong? What can we do different next time? Feedback. Now, I didn't talk a ton about this, but Troy certainly talked about it this morning, and we'll say it over and over again. And Simon talked about this. The leadership piece of this is key. I mean, at the end of the day, your people are doing everything they know how to do based on the experience that they've had over the years that they've been making tools or quoting tools or designing tools. The leader has to step up a level and talk about how you're going to change and, go after that brilliance that Simon talked about. When you really start to look at the data in shops we've been in, you see people's eyes just go, wow, I never knew. I just never knew we did that. None of this happens without leadership. So for you as business owners and presidents of your company, if you're not leading this change, nothing will change. And your profit will stay the same and you will continue to sort of sputter along. And so we just encourage you all to look at these steps of the process, put together what you learn over this day and a half and go back and figure that now's the time to really make a step change in your business. So that's all I have for you today. The presentation is available to all of you through the AMBA. I'll be here for the next 2 days. I'm happy to answer questions. And again, I'm very grateful for this opportunity to be with a bunch of friends again and share this time. So thank you.